A new Goldman Sachs survey shows Wall Street investors are still bracing for a recession. That is despite inflation easing and a healthy job market. So to explain how this all works, Robb joins us now. He is an economics editor for MarketWatch. Greg, thank you so much for being with us this morning. At this point, our investors, they're still bracing for a recession. How so?
Well, I mean, it's kind of a natural thing. It's normal because the Fed has been fighting inflation, and 10 out of the 12 times the Fed has raised interest rates to kind of slow the economy, they've overdone it and caused a recession. So when you have that kind of a batting average, people think it's going to happen again. It's a rare time when they kind of manage to get a soft landing. I do think now the idea that there could be a soft landing is kind of growing a little bit more. People are getting a little bit more optimistic, but it's still, it's one of the things economists are debating day by day, week by week.
Greg, Magic 8 Ball says all signs point to a soft landing, right? The inflation has slowed. Yeah, it's not at 2%, but it's going in the right direction. People still have jobs, some layoffs in some sectors, but not widespread layoffs. Economists are so pessimistic. This seems to be exactly what we're all hoping for. When are they thinking that this, whether it's a big R recession or a small R recession, could be coming?
Well, when people look at the economy and economists look at it, they don't have crystal balls. They can kind of see the next 6 months. And then after that, the economy, it's sort of like the curve of the earth. You just can't see further on. So I think that the smartest people are thinking about the first quarter of 2024. That seems to be when the economy is going to be at its weakest. It is slowing down now. There's sort of no question about that. Everything is inching down lower. So I think that is the time to watch. But it is that period of time where we have no information. And so that's why things can change.
Yeah, to that point, I feel like everyone feels like they're constantly bracing for that impact. So much of this has to do with consumer confidence. What does it look like as we stand?
Consumer confidence has picked up. I mean, the job market has been steady and the sentiment, inflation has kind of come down a little bit, and we had the debt ceiling passed. I do think consumers are sort of in a better mood than they have been in a while. They're just sort of waiting. I do think they're, cautious. Sentiment hasn't risen to levels above where it was before the pandemic. It's just, we're just in this uncertain time coming out of the pandemic, and people are uncertain.
So it seems like it's pretty reasonable to anticipate another rate hike from the Fed. I don't know how high it will be, but is that the expectation?
Yeah, I mean, it's a pretty much seemed like a done deal that they're going to raise interest rates next week. Fed officials meet next Tuesday and Wednesday, and we think they're going to go another quarter point. After that, though, it's sort of up in the air. They had sort of told everyone and signaled that they might do one more before the end of the year. But economists and the markets are starting to doubt that. It'll depend on the data. It'll depend on the inflation data. So it's up in the air. But one more next week, baked in the cake.
So, Greg, I have kind of like a broader question. I know that 2% inflation is the goal. But does it have to be the goal? Does it have to be where everything stops? Is there a possibility that running a little hot is not necessarily a bad thing?
I think many people are saying that. I think when you talk to Fed officials about it, they are really reluctant. They picked that target in 2012. It was a new thing. It was like the best new invention that they had, and it was the most interesting thoughts they had, and they kind of gathered on the 2%. They really don't want to change that now because it would, I think, it kind of on more confidence. This is what Fed officials say. They don't want to talk about that. But I think a lot of people in the markets and a lot of people think, well, if they can get inflation down below 3%, somewhere in the 2 handle, that they might stop being so aggressive about inflation and kind of hopefully that the inflation will ease down. So it is something to watch. But right now, core inflation still remains 4%. They're not close to their target now. So they just don't want to go there.
That's really interesting. I thought 2% was something that like came to light with the emergence of the Federal Reserve. I didn't know it was something that they kind of figured out less than a decade ago. That's fascinating. Greg, Robb, thank you very much.
Thanks for having me.